Welcome traders. Today is July 16th, Saturday. I thought we'd take a look at crude oil using my Fibonacci modeling system here on this daily chart. As you can see, we've got a crude oil chart showing the rally from December of 2021 all the way up to the peak here, and then rolling back through this cycle trend and now down to where we are at 97.59. What's important to understand when we look at this is how Fibonacci Price Theory creates a defined trending system and also shows us highlighted ranges where we can determine support and resistance to be critical. For example, we've got these highlighted range here with this a peaking level. We've got two green lines here, which is an upside breakup or an upside trigger level. Whoops. Let me come over here and try to highlight some of this. So we've got two upside breakout levels right across here, which is a very narrow channel, but still a valid support channel. Then we've got these levels right over here. Let me get rid of these. So you got this red line here, kind of lines with this. You've got a green line here, red line here, and then you got a red line way down here that, interestingly enough, coincides with this low and coincides with this low as a double bottoming formation. So in theory, we've got a very solid double bottom right across here. Get my mouse to cooperate. And then we've got this range set up right here, which overlaps really with this blue range that's over to the right. I'll still try to draw it. We'll draw it over here and over to here. And then we'll change the color real quick. Make it more of a purplish blue color. And what you can see is how these ranges create support and resistance and create zones for price. So now currently, if we were to look at what's happening in oil, okay, we've come down, we've rallied back above this high, we've run into resistance right over in this area, up into this topping zone, rolled back out of it, broke down below this resistance level again, come back down into the support zone, which was identified back over here and confirmed over here. We've rolled through that, stalled about midway through this trend, so it's come back about 50%, and now we've broken down to this lower zone, which is really down in this area, again, really kind of in this area. And what we're looking at is we've bounced off of this level. The Fibonacci modeling is saying that we're most likely to either try to go to 106.34 and stall below these levels. Remember, these levels indicate that this is bearish trending, and the bullish trigger here is way up here. So you can see we got to get to 122.15 based on Fibonacci Price Theory to be able to get into a new confirmed bullish trend. Why is that? Because we're in this sideways rotation. You can see the rotation, the trigger level here is 131.53 from this low, and is here at 122, roughly even at this for this low. So we need to see a substantial rally back to the upside before we're going to see any bullish trending in the crude oil, and we need to stay below these red levels here, 107.82, for confirmed bearish trending. Confirmed bearish trending shows us that we're going to go down to this blue level here, which is 92.66 or 89.06, or we come down to this level, roughly 79.62. Now let's go back and take a look at this longer term chart, because I want to point out that these levels on the daily chart are highlighting an area that if we stay in this green zone, if price comes down to this level and stalls above, say, 89, then we're still above this green zone. We may see another move a little bit higher. If price gets below this $89 level, then we start to move down into the $79 level. That's clearly below this resistance level and above these two support levels, which this is a dual level down here. Then we're likely going down to this 70, 69, possibly down into $65 level if we get below this $89 level. So understand that really very interesting is that predominantly we're in a bearish trend. There's very little upside for oil, in my opinion, on this daily chart. If it were to happen, we'd have to get well above this 108.50 level to see some sort of an upside move. Not saying it couldn't happen, but it could. And then we'd have to see it rally up above this 122 level for a confirmation of a new bullish trend. It could certainly do that if there's a major disruption in the markets. I'm thinking, though, that consumers are going to start disengaging globally away from oil. Remember, we do not have a supply issue with oil. There's plenty of oil in the ground. It's just that we have a refining issue. There is a lack of supply of refiners to convert the oil into usable resources for consumers. So now let's go ahead and take a look at the weekly, which will still show these same setups. I'm going to spread it all out so we get rid of that. And we can ignore that low. So we'll come back over to here, spread this out a bit, come back over here. And then we need to take a look at how these levels show up. So now pay attention to these three dots right over here. So we have a blue dot, a red dot, and a green dot. These are actually squares. But it's very, very important for you to understand that these levels indicate a triple, so to say, witching of Fibonacci price theory, aligning at roughly let me get a number here, 108, roughly 108.50, give or take a few. So now I am going to draw a rectangle or line through here, and I'm going to highlight it as bright as I can because this becomes a very critical level. Understand that you've got multiple Fibonacci theory aligning at this level. You've got three projected price levels aligning at this very critical level. We are now below that level. This becomes very critical resistance. We do not have any other alignment going downward. We do have a dot here at 86.20, which is an upward projection from the December low. And then we have a number of dots down here at 40 and below zero. We will ignore that, the below zero, although it could happen at some point. In reality, ladies and gentlemen, this becomes our target. We're in a downtrend. We're below the Fibonacci trigger level, which is right here at 108.37. We would have to get above this 108.50 level roughly to see any upward movement. We're dancing around this support level here, which may continue to act as support, but in reality, the next target here is 86.85 to the downside, which will put us right back at these levels. And then below that, we're starting to look again down in the $69, $65 range to come down and retest this low of roughly $61, $62. Fibonacci is very, very interesting to me because you can align it with almost any other type of analysis, but this adaptive modeling system that I've built really provides a great way of looking at the market. So we go back to daily, and let me show you something fun. So we come back in here, and let's go to 120. What I'm going to do is I'm going to show you a 120-minute chart. I'm going to shrink it way back down. And what I'm going to try to do is show you how these levels align. So we're going to be looking for these price levels, these red and green lines, like one right here. We got a couple here in the intermediate. We got one right here. So we have an unknown level that's coming in right in here. This is something that's new that we didn't see on the other chart. This becomes a potential level for intermediate support and resistance. We have got a number of levels down here, so let's highlight this as potential support and resistance. These are intermediate levels, ladies and gentlemen. These are not critical off of the daily. These are just intermediate types of levels. We've got a number of levels here. We have another one here, here, which aligns back with this intermediate peak. So I will draw this across here. And try to carry it forward. somewhere around there. So now we're using intra-bar or intraday bars, 120-minute bars, using the same Fibonacci theory. Remember, it adapts, and we're going back to apply these to daily charts. And this tells us on a daily basis that we have these levels in play, intermediate on the way up and down, that we should be cautious of. So we have a level right now, which is playing out currently down in this area, acting as support. We get below that, we need to be cautious of this lower level. We have upper intermediate resistance zones here and here that we need to be very, very cautious of if we started to move to the upside. But remember, we need to get clearly from where we're at right now, 97.59, up above 108 roughly, 108, 108.50, to be able to move away from bearish trending and potentially into an intermediate bullish trending phase. Remember, ladies and gentlemen, we need to get way up here to 122 to go move into a new bullish trending phase. So we would have to see a massive rally up into this yellow zone, reaching near all-time highs, or at least recent highs, to move oil back into long-term bullish trending. Overall, ladies and gentlemen, I think we're looking at a fairly big breakdown in the market. Let's take a look at monthly just for the heck of it, and we will ignore this breakdown here. It's going to skew things because of that deep, deep wick into negative. But let's take a look here, and you can see how things are aligning up near this peak. This low rotated, so we had a deep low here, intermediate high here, intermediate bottom here, predicted with the red and the blue a massive rally phase up to in this case 117.70 and 128 roughly, which is pretty much where we peaked out. This now peak is predicting downside move to 23. And we're predicting the blue level here roughly at 120, 121, which is close to our 122 bullish target off the daily chart. And then, of course, you understand we have this moderate, simple little projected level, which comes in at 50, call it 53.50. And this is a decent level for a downside move. In theory, that level becomes the most logical level on the downside for oil to reach, given the fact that it's very unlikely to try to rally up above these levels, although it could. We're in a current downtrend. You can see the resistance level here. You can see the buy trigger here. We could easily move down, and then this would be a very interesting move. It would be a deflationary move for oil, about a 45% downside move in oil to potentially target this $54, $55 level, $54.60 pretty much. That becomes the next primary level on the downside. Now, this is on monthly long-term projections. This level up here becomes extremely strong resistance. Between here and here becomes extremely strong resistance for oil currently. We've reached this total projection point. It's blown through it. It's reached it. It's stalled. It's converted back down. It reconfirmed it here. Now we're rolling over. We've got new lows. What we would be looking for at this point, ladies and gentlemen, we'd be looking for it to take out this next support level here around 89. And then it's off to the races down here into the $65, $64 level, possibly down here into this $54, $55 level. So that's how I use Fibonacci. And remember, this is my proprietary modeling system. This is something that does a lot of calculations internally. It identifies trends. It identifies setups, as I've shown you. It really does quite a miraculous job of understanding and tracking price trends. Now, this is a major topping trigger. The reason we don't have this moving up here yet is, and it will, is we don't have confirmation of a major breakdown yet over here off the weekly chart basis. So I hope you enjoy, and we'll be doing this on more. Please leave your comments. Please join my YouTube and Twitter channel. If you like this type of analysis, I can do more of it, showing you what I do and showing you some of my tools. I have hundreds of different modeling and triggering systems at play. Remember, as you're following my research, please take a moment to come back over here to the my website, mint.com, and create your free account. You'll get access to all of my research under the live trade section and under the trade tank section. This includes my weekly videos, which you have access to here. You have access to the weekly summary, which is detailed. In fact, I'm building it right now, this is last week's summary. You can see all of the detail that I put into every weekly update. It keeps you abreast of everything you need to know. And again, remember, I'm providing you all of this information for you to make decisions. This is not something where I'm going to turn around and tell you, buy this, sell this, what have you. I'm going to turn around and give you my interpretation of what I see. You can decide what you want to do. I give you these trending models every week, and I give you the hypothetical 401k retirement account allocation gauges. This is ideally how I think everyone should have their accounts. This is kind of how I am set up right now. I do make my own trades, I do make my own decisions, and I'm pretty much telling you what I'm expecting, what I think is going to happen, and what I think is best to protect my account. You can follow this all you want, do whatever you want to do on your side, but I'm trying to teach you how to stay away from these major market trends. Remember, I've been doing this a long, long time, and I create these incredible charting systems. Let me show you here. They give us opportunity to see things and custom indicators and know where market trends are setting up. So what I'm trying to do with you right now is I'm trying to help keep you away from risk. So for example, the rest of the world was still trying to buy into the market and chase the rally in 2021 and 2022. Whereas my custom indicators in before 2021, actually right here after COVID, this is basically COVID right here, showed a rally up through COVID, and near the end of 2020, middle end of 2020, my custom indicators started showing that we were entering a declining market phase. So I've been warning everyone to sell out of this market top well before the peak happened in January, February 2022, because my custom analysis and my work helps me gauge market strength and trend. So for example, I knew that we were entering into a downward phase in 2015, 2016 at this peak, and we ended up in a bottoming phase in early 2018, roughly right after the bottom in 2018, which started a big rally to the upside, which gave us a huge opportunity. Remember, the end of 2018, that deep decline because of the Fed, that's right here. This is the deep decline because of the Fed. And then look at this nice solid rally coming out of it. Okay, please follow my research. I'm here to try to help you, and I hope you enjoy this oil chart. Talk to you later.